Sometime in early 2028, a single pre-programmed line of code will execute, and overnight, the revenue of every Bitcoin miner on the planet will be chopped in half. For many, it will be a death sentence. This event is the Bitcoin halving. It happens roughly every 4 years, and the next one will push countless mining operations to the absolute brink. Their machines will go silent, their facilities will go dark, and their dreams of forging digital gold will turn to dust. But a select few won't just survive this digital reckoning. They'll emerge from it stronger, more efficient, and more powerful than ever. They will consolidate the market, absorb the assets of their failed competitors, and tighten their grip on the future of Bitcoin's network. So, what separates the winners from the losers? It's not about luck. It's about a series of critical decisions made years in advance. In this video, we're going to break down the brutal economics of Bitcoin mining and reveal the key strategies around hardware, location, and finance that will determine who survives the next great crypto shakeout. Before we get into survival strategies, we need to understand the mechanism that makes this event so terrifying for miners, the Bitcoin halving. At its core, the halving is a fundamental feature of Bitcoin's code, designed by Satoshi Nakamoto to control the supply of new Bitcoins, mimicking the scarcity of mining a precious metal like gold. Every 210,000 blocks added to the blockchain, which takes about 4 years, the reward that miners get for adding a new block is cut in half. We've seen this happen before. The reward started at 50 BTC per block, dropped to 25, then 12.5. In April of 2024, it was reduced from 6.25 to just 3.125 BTC. The next halving, estimated for the first half of 2028, when the blockchain hits block 50,000, will slash that reward again, down to a mere 1.5625 BTC. Let's put that in perspective because the numbers are staggering. A new block is mined roughly every 10 minutes. If Bitcoin is hypothetically trading at $100,000, the total reward available to miners globally drops from about $312,500 every 10 minutes to just $156,250, and that's before considering that miner revenue also depends on transaction fees, which can be highly volatile. A 50% pay cut enforced by code happens in an instant. This isn't just a technical tweak. It's a seismic shift in the economics of the entire industry. For a business where revenue is already unpredictable, having your primary income programmatically chopped in half is a crisis. It forces a brutal reckoning where only the most efficient and well-prepared operators can hope to stay profitable. Every other business in the world fights to increase revenue. Bitcoin miners have to plan for a future where theirs is guaranteed to fall off a cliff. This brings us to the miner's dilemma. When the halving strikes, a miner's revenue per block is instantly cut by 50%. Their costs, however, are not. In fact, their costs are likely to keep rising, creating a devastating squeeze on profit margins. This is the death spiral that will claim so many operations. The single biggest operational cost for any Bitcoin miner is electricity. It's the lifeblood of the industry and can make up the vast majority of a miner's total expenses. To stay profitable, miners have to find incredibly cheap power. The most competitive operations are securing power for under 5 to 7 cents per kilowatt hour. After the 2028 halving, a rate of 10 or 12 cents per kilowatt hour, which might seem reasonable in other industries, will make it extraordinarily difficult for most Bitcoin miners to stay in business. The second factor is the relentless march of technology. The specialized computers used for mining, called ASICs, have a very short shelf life. Every year, new models come out that are more powerful and energy efficient. As these new machines come online, they increase the total computing power of the Bitcoin network, known as the global hash rate. According to Bitcoin's code, the mining difficulty automatically adjusts to ensure a new block is found about every 10 minutes, no matter how many miners there are. So as the global hash rate rises, the difficulty increases. This means older, less efficient hardware has to work harder and burn more energy just to have the same chance of mining a block. This is what creates the squeeze. A miner with older gear sees their revenue cut in half. At the same time, network difficulty is rising, further reducing their chance of earning anything at all. Their power costs stay the same, but they're earning less Bitcoin for every watt they consume. They can't afford the next generation of hyper-efficient machines, so they fall further behind. Profitability vanishes, cash flow dries up, and eventually they have to shut down for good. This isn't a theory. It's the unavoidable reality that will weed out a huge portion of the industry. So how do the survivors avoid this fate? The first and most critical battle is fought in the hardware arms race. In the world of Bitcoin mining, your primary weapon is your ASIC rig, and victory belongs to those with the most advanced technology. Post-halving efficiency is everything. The key metric isn't just hash rate or raw computing power. The real game changer is how much energy a machine uses to produce that hash rate. This is measured in joules per terahash, JTH. The lower the number, the more efficient the machine, and the more likely it is to stay profitable. The new generation of hardware is a quantum leap in this metric. Machines like the Bitmain Antminer S21 series are pushing the boundaries of what's possible, with some models boasting efficiencies in the range of 15 to 17.5 JTH. To put that in context, many older but still widely used machines like the Antminer S19 family have efficiencies closer to 25 or 30 JTH. This means the new machines can produce significantly more hash rate for the same amount of power, a monumental difference when electricity is your biggest cost. This makes upgrading hardware a non-negotiable strategy. The good news for well-capitalized miners is that the cost of hardware, measured in dollars per terahash, has fallen dramatically over time, making it more feasible to continuously cycle into the latest equipment. The arms race also extends to the infrastructure supporting the hardware. Advanced cooling technologies like hydro and immersion cooling are becoming mainstream for serious operations. They allow machines to run harder without overheating, boosting output and extending their operational lifespan. The top miners know that winning the hardware race isn't just about owning the newest rig, it's about creating an entire ecosystem that maximizes performance and minimizes cost down to the last watt. This level of strategic investment is what separates the professionals from the hopefuls. If you're finding this deep dive into the business of Bitcoin mining valuable, take a moment to hit that subscribe button and ring the notification bell. We break down the complex economics of the crypto world so you can stay ahead of the curve. Owning the most efficient hardware in the world is useless if you're plugging it into an expensive power grid. This brings us to the second pillar of survival, mastering the global chessboard of energy. If hardware is the weapon, cheap electricity is the ammunition. As we've established, electricity is the single largest operational expense, and locking in a low-cost, long-term power source is the holy grail for a Bitcoin miner. The smartest operators are no longer just tech companies. They're becoming global energy strategists, scouring the planet for stranded or underutilized power. A dominant trend is the migration of mining operations to regions with abundant, cheap, renewable energy. This isn't just for PR, it's cold, hard economics. Hydroelectric power in parts of South America or Scandinavia, geothermal in places like Iceland or El Salvador, and vast solar and wind farms in locations like West Texas offer some of the lowest electricity rates on the planet. By co-locating facilities next to these power sources, miners can often sign long-term power purchase agreements, PPAs, that lock in electricity costs far below market rates. Some large miners are even acquiring their own energy assets, like Marathon, which recently acquired a wine farm in Texas. This has led to several distinct strategies, and the first is direct ownership and co-location, where a mining company builds its own data center connected to a power plant, and this requires immense capital but offers the most control. A second popular strategy is hosting, where a miner buys their ASICs but pays a specialized data center in a low-cost region to run the machines for them. This shifts some of the infrastructure risk and offers more flexibility. The most sophisticated players are also pursuing geographic diversification. They don't bet on just one country or one power grid. They spread their operations across continents to hedge against political risks, regulatory changes, and local energy market fluctuations. They are playing a multi-dimensional game of chess where the goal is to secure the cheapest, most stable, and most resilient power on Earth. Surviving the halving isn't just about physical assets. The third piece of the puzzle is financial sophistication. The most resilient mining companies are operating less like simple commodity producers and more like advanced financial firms, using clever tools to manage risk and stabilize revenue. The core problem for a miner is volatility. They have fixed costs in dollars, but their revenue comes in Bitcoin, a notoriously volatile asset. To combat this, large-scale miners are increasingly turning to derivatives, a tool long used in traditional commodity markets like oil and agriculture. Specifically, they are using products like hash rate forwards. Think of it like a farmer selling their future harvest at a fixed price today. A hash rate forward allows a miner to lock in a guaranteed price for their future computing power. They essentially sell their future hash rate to an investor at a fixed rate, guaranteeing a certain level of revenue no matter what happens to Bitcoin's price or network difficulty. While this market is still developing, it provides a crucial tool for creating predictable cash flow, which is vital for long-term planning and reinvesting in new hardware. Alongside these financial instruments, operational excellence is key. Top miners use software to track the performance of every single ASIC in real time, monitoring its temperature and output. This allows for predictive maintenance, ensuring maximum uptime. In a game of razor-thin margins, every hour of lost hashing power is lost revenue. By mastering these financial and operational tools, miners can build a fortress capable of withstanding the shock of the halving. So, what does the future of Bitcoin mining look like after the 2028 halving? All signs point to the halving acting as a great filter, triggering a massive wave of industry consolidation. The brutal economics are unavoidable. Miners with older hardware and high electricity costs will see their profits evaporate. Many will try to hold on, hoping for a Bitcoin price surge to save them, but for most, this will be unsustainable. They will be forced to power down and exit the market. This is where the titans of the industry will make their move. The large, well-capitalized mining companies, the ones who optimize their hardware, secured cheap energy, and hedge their revenue, will be waiting. For them, the shakeout isn't a crisis. It's a historic opportunity. As smaller miners go bankrupt, their assets will be sold off, sometimes at steep discounts. Industry giants will swoop in, acquiring data centers and fleets of late-model ASICs. This consolidation has been an ongoing trend, but the 2028 halving is expected to accelerate it dramatically. The result will be an industry dominated by a smaller number of larger, more professional, and incredibly efficient players. The era of the hobbyist miner being a significant force is long gone. While they still exist for ideological reasons or in niche situations, their share of the global hash rate is tiny. The future of mining is industrial-scale infrastructure, sophisticated energy procurement, and Wall Street-level financial management. For the Bitcoin network, this has profound implications. A more professionalized mining sector could lead to a more secure network. However, increased consolidation also raises valid concerns about centralization, as fewer entities will be responsible for validating transactions. The 2028 halving won't just test the survival of individual miners, it will be a pivotal moment that reshapes the very foundation of the Bitcoin network. The 2028 Bitcoin halving isn't an apocalypse, but it is a reckoning. It's a built-in stress test designed to ensure only the most efficient and committed participants remain to secure the network. Survival won't be an accident. It will be the result of a three-pronged strategy: a relentless pursuit of the most efficient hardware, a global quest for the cheapest energy, and the disciplined execution of sophisticated financial management. The miners who master this trifecta won't just survive. They will define the next era of Bitcoin. What do you think is the single most important factor for a miner's survival heading into 2028? Is it hardware, energy, or something else entirely? Let us know your thoughts in the comments below. And if you enjoyed this deep dive, please give this video a like and subscribe for more analysis on the future of the crypto industry. Thanks for watching.